Welcome here. We have, I think, about 1 hour. I hope that we are a small group, that you will have a lot of questions, remarks about the things I will talk about that makes it interesting for you and for me. Because the new world of the financial sector is uncertain. That's, I think, the least you can say. It are very special times. You have, for example, a financial system like the euro system was almost bankrupt in 2012. Then we would not have had the euro anymore. Unfortunately, at that time, we had a certain Mr. Draghi, Mario, who said, "I will do whatever it takes to rescue the euro." Clearly, that was not allowed, because his mission is not to do whatever it takes. That person should be in jail. But everybody was happy that he was doing what he should not have done. And in the meantime, we have negative interest rates since 5 years, even on 10-year bonds for Germany. We have a balance sheet of the ECB of 8 trillion, which makes it the biggest bank competing with the Federal Reserve, which is also at 8 billion, and plans to increase the balance sheet with another couple of trillions of euro. At the same time, the inflation is at 5 to 6% now in Germany, I read. But Mrs. Lagarde, the successor of Mr. Draghi, says that's not a problem. While the Treaty of Maastricht and the reason of existing of the ECB was to fight inflation at any price to avoid that inflation goes above 2. How will this end? I don't know. And when will it end? Anywhere, I think the dilemma for Mrs. Lagarde is, if she now increases interest rates and the pressure at the ECB will increase. Mr. Weidmann of the Bundesbank has already said, I'm not going to work together with these people. But if she increases the interest rates, I imagine that within 1 year, Greece is bankrupt. With the public debt of over 200% of GDP, and already weak, economically still a weak country, it's the end of Greece again. We've seen that before, but Italy will follow now. Unless, together with increasing interest rates, you find solidarity that the rich and powerful countries, first place Germany, are agreeing to support Greece. Something they, by definition, refuse. Because the German spirit is convinced that Greece is responsible. And then they should find their own solutions. So that's the money. What will happen with the euro? I don't know. What is the probability that in 10 years we have still a euro? I would guess pretty low. We will have something else. I'm not talking about the Götterdämmerung and the end of the gods. There will be something else, but nobody knows what. At the same time, you see, of course, potential competitors to take over the role of money. And a big question today among politicians, but also among economists, is the Bitcoin, is that money or is it not money? We don't know. It's something like money, but it is not money. There is I know of one case where the European Court of Justice took a decision already in 2016 with the question, that was for the application of VAT. Because if Bitcoin is not money, and you buy and sell, you have VAT. So you pay 20% VAT when you buy, 20% VAT when you sell. The only way to avoid paying VAT is to say that it's money. But if it's money, you enter a totally new world in the financial system. And then the Court of Justice decided in their explanation that Bitcoin is not money, but does things that are similar to money, and therefore is exempt from VAT. This is just an illustration to show you that getting involved in the financial system, changing certain things, creates a lot of problems, not only in IT, digital, what is the role of banks, but the stupid tax treatment is one of the major elements. Because what? Why? Because the financial system is public domain and has an exemption in a lot of things that normal businesses have. And that's the reason why also banks do not pay VAT. It's one of the only companies that do not pay VAT. Why? Because VAT is value added tax, and because there's no value added in a bank. It's zip. The value of what the bank does is zero. It's producing nothing useful. You cannot eat what they produce. You can do nothing with it. It's even on the surface. Nobody knows what it is. Since 2000 years. And on top of that, banks are using interest rates, which according to all religions and old philosophies in world history is unethical. Just talking of interest rate, and it's not done. It started already with Aristoteles, the Greek philosopher, who said interest rate must be forbidden in Greece because it destroys society. And he said, when you rent a pig, then you can ask a price for the rent. Why? Because a pig can make small pigeons. So it's productive. But money, and that was gold at the time, is inert. It doesn't grow. So when you lend something, you can ask the same thing back. But that it is not growing, you can only take back what you have lent. What you have lent. Because otherwise, yes?
Sorry to interrupt you, but is it so simple? Because, okay, in your explanation, a bank doesn't offer a service. And a service still is something that you provide to a customer. And I think that for providing a service, you can ask a price. And so that means if you can ask a price, and that also means that you provide someone added value.
Yeah, but there is no tax.
Sorry?
But there is no VAT.
But that's good, of course, for us as a bank.
But why?
For a customer.
The whole economy has, as a system, if you produce something and you buy or sell it, then you have VAT. 6%, 20%, you name it. And then suddenly, the Parliament has decided, but not banks.
Yes, but that doesn't mean that they don't offer added value.
Okay. I just give.
Sorry, I'm
I give some examples about how strange the financial system functions, how exceptional it is. And what I see is that even seasoned bankers do not understand their own business. They think that a bank is a company that must make profits. They don't pay VAT. That's about that. Why this exception? We use interest rates. While all the old philosophers said interest rates that's unethical, should be forbidden, because money is not productive. And of course, that's before the economists of the 19th century saying if you invest, you can build machines, and with machines you increase productivity. So if you have a financial system that facilitates that innovation, then the capitalist has the right to take a piece of the productivity gains he has produced. Aristoteles, in that time, it did not exist. But still, it's a very strange thing. And we should not forget that until the 14th century, in the Christian world, interest rates was strictly forbidden. It was forbidden. You were burned if you used interest rate. So in order to get out of that problem, because then we had already a pope in the Christian world who has a direct line with the big boss, and that pope was extremely unhappy that you didn't have interest rates or you didn't have bankers. And who was then becoming the bankers in the Middle Ages for the Christian world? The Jews. The Jews were there to do all the things that Christians were not allowed to do. Because for the Jews it was not a problem, because in the Jewish Bible, interest rate is forbidden among Jews. But they can apply interest rate with non-Jews. Why? Because for them interest rate was a weapon to destroy another people. Because the whole Bible is all about fighting and destroying and murder and all. That's a very interesting book. But not really a book that represents peace and equality. So these Jews were all the time fighting. And the theory was, just what Aristotle has also said, if you apply interest rate, you will weaken the other party. Because that other party has to pay more back than they receive. And that will make them weak. And then the Jews said, but that's excellent for us. If we can lend money to non-Jews, they will pay us back more, so they will become weaker, which means their army will be weaker, and we get the money, we can afford a bigger army, so we will win. So finance is a weapon to destroy other civilizations. That's the old time. And then we get to the Pope in the 13th century, who himself had to have an army to fight with everybody, the German emperor and Philippe le Bel and all these people. And he was, the Jews were asking 15% of interest rate in the Middle Ages, so he was very unhappy. And then he asked one of his people in the Vatican, Thomas van Aquino, please read again the Bible. What has Jesus Christ really been saying about interest rate? And then Thomas came down and he said, well, I've been reading carefully, but I have a solution, boss. Because a banker asks a rent, and that's called interest rate, but that's not a rent for the money, that's a remuneration for the work of the banker. And there we come to your remark. That's Thomas van Aquino. We are already in the 14th century. Who said a banker has to be careful to whom he gives money. Will that person be able to pay back? The banker needs to bring the money, and to get it back, that's working. So it's not the money that brings the interest rate, it's the work of the banker. So small interest rate is fine, but high interest rates are forbidden. And from that time, the Christian world makes the interest between the normal interest rate and then very high interest rates, which are still considered to be an abuse. And based on that, the capitalistic system and the bankers like the Medicis could develop without being burned. Just to illustrate in which world we are when we talk about finance. It has been a headache since ancient times, and it remains a big issue. So thinking I'm active in finance is just like producing cars or doing whatever or making software. As soon as it's finance, it's dangerous. And it's totally special. And that's why that whole financial system has a totally specific treatment, of which VAT is just one example, but If I would ask what is special in tax treatment of the financial sector, I think very few of you would have said buying and selling one currency against another can happen without VAT. If you exchange the dollar against the euro, there's no VAT. There can occasionally be a stamp tax, but that's another issue. So very few people are really aware of the very strange logic that we have in the financial system. Because it's a very strange thing. And I see that a lot when I talk to people in the fintech. I'm not saying they're naive. They're driven, they want to make progress, they want to do everything possible. It has to go fast, they can do it better than the traditional financial system, but the purpose of the whole regulation is not to make it more efficient. Very often the purpose is to make it inefficient. Because we don't like the financial system. The financial system will destroy us. Minsky, 1970. I'm not going to continue as an academic, but a little bit of history to mention all these things that very few people, even in the financial sector, are not aware of. Minsky, one of the students of Keynes, he already was writing one big book. It's not a big book, it's 200 pages. With only one book, and he died relatively early, and it's called Stabilizing an Unstable System. In which he said the financial system, it's a system, it's not a product, is by definition unstable. Which means if you let it do what it does in a normal free market, it will be self-destructive. And with its self-destruction, it will destroy whole society. So it's a monster. So you have to do all you can to keep the monster under control. It's like a nuclear reaction. It's by nature unstable. And you have to put walls around it, you have to take precautions. And even then, and that's the last sentence of his book, he says, and even if you have found the best system that makes you convinced that the monster is under control, it will start to mutate, COVID. And it will appear in a different form from somewhere else that you never expected. So never think that the monster is tamed, because it will transform itself into something else that will again come up and destroy whole society.
Yeah, but one could say as well that if you found a system to block the model, it realizes that it's blocked, so it finds another solution. So your first solution was good, if you understand what I mean.
But it was bad. And I think if you now look at what the regulators are saying, it's a little bit more intelligent than what, again, a lot of people think. They have not said after the crisis of 2008, now we are going to build Basel III, and with Basel III the banks will be so stable and so prudent that there will be no crisis. No, they have only said we will have a regulatory system so that crises are less frequent, and that if there is a crisis, the impact should be less important. So it's about contagion of society, of fighting contagion of society if there is a crisis. And that means, of course, that your system is by definition inefficient. If there's one big Belgian economist in the financial sector, it's Lamfalussy. I heard him several times explaining why the purpose of the financial system is inefficiency. To keep the monster stable. Now, if you look at the financial system in that way, you get to another approach of what can I do and what am I allowed to do. Because taming the monster, that's the whole regulatory framework. Knowing that it's not perfect. And knowing that at certain times it will not help. And that's why in Basel III and then later in the directives of Europe, you have specific regulation of all the firewalls in the financial system. First of all the operators in the banks should have buffers. Own capital, liquidity, should be fit and proper. It's the ethical thing again. People who manage a bank should be fit and proper. So before you become a CEO, you have to do an exam at the supervisor now. And the fit and proper test, when I was a young banker, that was 1 page. And today it's 50 pages. Is it useful? I don't think so. But nevertheless, that's how they try to tackle it. Fit and proper. If you want to sell shares of a bank, if you are a reference shareholder, you have to ask the supervisor. And he has to accept the new shareholder. If you want to fire your CEO, you have to ask if you are allowed to the supervisor, who has to know who will be the successor and has to agree with the successor. Is a bank really a private company? That's a bank. And then the market, for that bank, so you have all the safety nets, the Basel buffers, you have the lender of last resort, the bank, if it has no liquidity, it's the only institution that can knock on the door of the ECB and ask for money. The lender of last resort. And the ECB will create money to rescue a bank. It's not allowed to go bankrupt. Is that a private company? In a market? It's a biased market. And then you have the deposit guarantee, where government says, if your bank nevertheless goes bankrupt, then we will pay you up to 100,000 euro for your deposit. So if you have more than 100,000 euro, guaranteed 100,000. But if you open a second account and you put your 200,000 euro in 2 banks, you have twice a free insurance, guaranteed by government. And then the bankers complain that they have to pay a fee to the deposit guarantee. Do they imagine what society is offering to these bankers who are dreaming about bonuses and efficiency? Well, everybody says these are dangerous people. And I hear supervisors say, we first thought in 2008 that they have learned their lesson, but we're not convinced anymore. If they have the opportunity to do the same thing, they will do it. And now you have a strange attitude of supervisors that they say, if bankers complain, that means that we are working well. The more they complain, the happier we are. So bankers who think that they will complain and convince the supervisor, do something different. And then, yes?
Can I ask a question on the, how big is the information asymmetry today between supervisors and the bank?
It's big. It's big.
Is it smaller than before, or how do you see it?
Well, it depends, but that's why, for example, ECB, but also, and that's also fintech, with Anacredit, is growing to a granularity that could go ultimately that every individual transaction that any bank does will be on an individual basis reported to the ECB. Of course, for our society, about privacy and the political equilibrium that one institution should not become too powerful, then you have really big brother. Because the ECB then has all loans and all transactions of everybody with any financial institution. That's what they want. Is that sound? I don't know. And we will have lots of political debates about that thing. Because at that time, banks will not do their own stress test anymore. there is a copy-paste of the whole balance sheet of any bank at the ECB, and the ECB will make their own stress tests. What's best? I don't know. Even today, again, the EBA, I think it was yesterday, said we are going to launch new rules. Because we have seen during COVID that some banks have again made sophisticated models to prove that risk is no risk, signed by academics, based on complex assumptions that nobody understands, certainly not the banks. But some banks take more provisions systematically for the COVID risks than other banks. So you have a problem of level playing field between the banks. Because the banks with the best model have the highest shareholder equity because they don't take provisions and are more competitive than the serious banks. Another element of, strange element, the most competitive banks are the most dangerous. Are able to leverage most, to lie in their accounting most, lie, to tell a certain truth, that allows them to do transactions that other banks will not do, because they're too dangerous for some banks, but not for those banks. And you are starting the models as the commercial competition arm and instrument of the banks among themselves. That's why you have in Basel III, in the latest version, that some banks call Basel IV, but it's Basel III. Some talk already about 5, but that does not exist. Banks are talking about Basel IV, but that does not exist. It's the last chapters of Basel III, where Basel Committee only came to a conclusion in 2018 and had to be implemented in 2021. That's why in Basel III they set floors and caps to say to the banks, you are not serious with your models. For some, mortgage loans are risk-free, and for others there's a big risk because they take into account a scenario of a real estate crash. That creates an uneven level playing field. And the weapon of the banks is creativity in the model. But I'm losing a lot of time. Just to say how complicated the situation is. I remember when I was then at Fortis chief economist, and I was teaching at the VUB, and Vlerik, and the head of the banking commission in Belgium was Wijmeer. A very serious person. We were discussing very often because I'm an economist but very interested in older disciplines also like law. He is then a lawyer but very interested in the financial sector. And one day he said to me, when Basel II was there and we had to be ready by 2004 and Fortis was introducing its folder, 5,000 pages of formulas for the internal models of Basel II. And then Wijmeer told me, yeah, but I have a problem. I see all these bankers arriving with their encyclopedias of models. I'm a legal specialist, I don't understand anything. But what's worse, I'm convinced that the CEOs who come to talk to me don't understand either. But I have no argument to refuse the model, so I accept it. And 2 years later, we had the banking crisis. Why? Because banks in the run-up to Basel II were able to double their balance sheet without more equity. It's as simple as that. Look at the balance sheet totals of European banks between 2004 and 2008. The economy was not doing well, but not exceptionally. Balance sheet doubled with the same equity, because with the models, bankers were proving, demonstrating that risk was no risk anymore. So that's why we are in such a strange world in finance. It's a monster. But fortunately for bankers, a monster that we need to support the real economy. Because you have a real economy, and that's what's important. That's production, working, producing useful things with value added, that in a market economy, in a capitalistic economy, are then sold. And if you work, you get a salary. With your salary, you get a part of the pie of the GDP. The bigger that pie of GDP, the better it is, because then everybody is better off, and we call that progress. Now with global warming, we have some other debates, but that's something else. And then you have the financial economy, and that's the monster. And that's a set of contracts between people about giving cash and getting a contract, a promise that you will get something back later on. With, of course, the big risk that you give the cash, but that the other person will never pay back. We all know credit risk. It's one of the elements of the monster. But why do we need it? Well, you need financial intermediation in the real economy. You have the free economy, the communist system, you don't have that problem, but you have others. And people can decide to save. Individually, saving can be very rational and very useful. You save because you want to build reserves for your pension. You save because you want the buffer. So it's the prudent person. Fine, congratulations. But suppose that everybody is saving and keeps the savings under his mattress at home. What would be the result for the real economy?
No funds available.
Yes, no funds available. They are on the mattress.
No spending, no circulation.
A structural recession. Because if everybody starts to save and keeps the money, you get money because you have produced, be part of the production chain. Therefore, you get money. Ultimately, all the money you get should be used to buy the things that you have collectively produced. Now, if people save, they create a black hole. Not everything will be sold collectively. And now some countries say, yeah, is that good that not everything is sold, we are going to export. Like the Germans, that's completely irresponsible. And then they say, we are the champions in export. But that's dramatic for the world economy. But so they save and they bring the real economy into a place you don't want to be, is a structural recession. Those economists among you still know from the first bachelor the savings paradox. But everybody forgets that very quickly. Savings paradox. If we all want to save, we will just collectively get poorer. Saving is dramatic. Keynes said in the 1930s, saving is stealing the food out of the mouth of your neighbor. So you have to punish savers. That's what we are doing now. Negative interest rates, inflation, and tax on wealth. It's not really very good to say you have to build reserves for your retirement. But retirement is the long run. And King said, in the long run, we're all dead. So retirement is not a priority. Spending is a priority. Even if it's then deficit spending. How can you avoid this dilemma? Well, by finding people who have no money but want to spend. So you have to find an elegant way to take the money from those who save and bring it to those who don't have money but are going to spend. Draghi once was dreaming about helicopter money, was the same thing. But in the most basic form, you need a bridge between the pluses and the minuses. And that's where financial intermediation is a value-added activity, but outside everything else in GDP. Because what you do then is lending and borrowing. And that is something you can do using commercial banks. And the bank is then a public company. I started my career at the ASLK CGR. It was a public company. And at that time, in the 70s, 80s, almost the whole financial sector in Belgium was public. You had SLK, you had Crédit Communal for the local communities, you had SNCI for the industrial finance, and then you had cooperatives like SERA for agriculture. That was a very segmented market. For each type of clients, you had a specific financial institution, but the real banks, that was nothing. When I made my PhD, I was looking at the balance sheets of commercial banks in the 1960s, 70s. What do you think was the most important element on the balance, on the liability side of these banks? Demand deposits. 95% demand deposits. And what was the asset side? Short-term credit to the industry, the commercial loan theory. You can finance the commercial production cycle, but not more. For investments, they had to run to the NMKN, SNC. That's the 70s, that's not the Middle Ages. Yeah? And the bank was not allowed to do anything else. Like the Glass-Steagall Act in the US and Royal Decree 185 of 1935, splitting the holding from the bank, the protocol of the autonomy of the banks, banking commission, etc. So the commercial bank today is most of the time a private company. I have nothing against that, it's fine, but there are other drivers in a private company than in a public company. There are some that are very well, try to do the job correctly, being sometimes penalized by the market forces, etc. Some competition is very healthy. These public banks, there are a lot of accidents with public banks also, because people are, well, they're protected because they are a quasi-monopoly and dominated by politicians, which is not a guarantee either. Yeah? So a mixed system seems not too bad. And these commercial banks collect all the savings, tell to these people, don't worry, be happy, your money will always be available. In reality, behind the back of their clients, they give that money in a risky way to SMEs, to everybody who wants money. And then they call themselves deposit banks. That's terrible. That's organized crime. Because if you are going to deposit your luggage at the railway station, then the guy who takes your luggage says, you have to pay me because I will keep your luggage here. And you can anytime come and I will give you your luggage as it is. It's your luggage. If that person would do the same thing as bankers, he would tell you the same thing, and then you leave his office, he opens the luggage and says, I have nice pants, some socks, who wants this, who wants that, and the luggage is empty. And if you then come to that person saying, I want my luggage back, that person says, but there is no luggage. It's all gone. So it's certainly not a deposit bank. Yeah? And a deposit account is something else. But it's the purpose of that bank to do it, because that makes the real economy function. So you have a huge contradiction. What bankers do and what for society is essential, it is a big lie. And then when the monster wakes up, then suddenly bankers for the public become gangsters. But if the monster sleeps, bankers are the champions. The definition of what we call a bank, but that does not legally exist, the legal name is credit institution. The CRR, the big law European, defines the bank. A credit institution means an undertaking, the business of which is to take deposits or other repayable funds from the public not from the wholesale markets, from the public, retail, and to grant credits with that money for its own account in its own name. Everything that is not that is not a bank. I don't see anything about payments, anything about securities, markets, about 90% of what banks today do. So you have a definition that defines a bank as the most narrow bank you can imagine. And then in that same law you have a series of exceptions in the annexes that banks are allowed also to do other things, as far as they are not in contradiction with the prime purpose of why you have a bank. When CRR, I was then still chief economist at Fortis and responsible for the group of the European affairs, so a little bit lobbying, but and I asked my bosses, should you react to this definition? Because ultimately, it's so easy to say we don't have to change the law. Narrow bank, that's a bank, and all the rest is forbidden for a bank. But they found that that was not necessary. So a bank absorbs all the risks, promises to the deposit holder, the saver, don't worry, I will pay you back, and takes all the risks for its own account. It's a big lie, and only banks are allowed to lie. All other institutions are not allowed to lie. And because they are allowed to lie, because they are needed in the economy, well, they need to comply with a whole series of regulation to protect those deposit holders. Now you have an alternative system, and that's the market. After the 1930s, about everywhere in the developed world, that was no-go, forbidden territory for bankers. When I was a young banker, there were two places where I could not enter, and that was a casino and the stock market in Brussels. You could not even put your feet in the building. Directly you were rejected. In the office left, so that you couldn't see nor hear anything about what happened in the stock markets. That was until 1990. It's not the Middle Ages. And then they repealed Glass-Steagall, and then you had the reform in London, you had the reform of the Belgian law, and then suddenly banks were allowed to do all kinds of things. Yeah. But the market is another way of intermediation. And in the market, you don't have borrowers, you have issuers, bonds, stocks, all what you want, very creative, and you don't have savers but investors. And the investors are going to check and choose the contract in which they believe. That can be a government, that can be Solvay, that can be anything. And here you have a lot of creativity to make the contract nice, looking nice, to convince the investor that it's a nice contract. That's a market environment. And you have, again, specialized, here you have specialized service providers, not only banks. In the past, even forbidden for banks. You have brokers, you have investment advisors, you have asset managers. It was all strictly forbidden for banks until the 1990s. And here you have the investment bankers, which were no banks. The Goldman Sachs and others were securities houses. Did not profit from all the protections of banks, of lender of last resort, and deposit guarantee. The rule in the market is you make your choice, you buy your contract, if something goes wrong, it's your trouble. In the north you have the basic of regulation, Basel, and the supervisor is since 2014 the ECB for Europe. In the south you have MiFID, organizing conduct, and as a supervisor, the national Belgian FSMA. So a bank that is active in The South and the North has two supervisors at least, who both have totally different goals. The North is protect the bank because the bank keeps all the savings of the people, and a bank in problems is a political, social, economic catastrophe. The South is everybody takes the risk he or she wants. If something goes wrong, that's not the problem of society, but we need to reassure people that those who are active in that market as intermediaries are honest and reliable. The conduct must be perfect. Transparency must be perfect. Transparency about everything. In the bank is totally intransparent. It's a black box. The market, you have to be transparent. But everybody takes its own risk. So this is the two parts of the financial intermediation. And these two are complementary. The butcher who wants to buy a refrigerator is not going to issue a bond. He is going to a bank to ask for 10,000 euro. Solvay, who needs 5 billion to build a new factory, will not go to a bank for a loan, will issue a bond. So you have the traditional, normal, natural difference between retail and wholesale. And the retail has to be protected, and there you have that huge layer of consumer protection. And the wholesale is considered to be intelligent enough to protect themselves. You only have to take care that the market is honest, that you don't have inside trading, that you don't have market manipulation, that you don't have all these things. That's market. You're not interested in the outcome. In the bank, you're interested in the outcome, that the bank is not falling down. So that's why the regulation is very often contradictory. And then it's also a cultural choice. For example, in the US, GDP is the orange. The balance sheet total of banks is the blue. And that's Europe. In the US, banks' balance sheets are less than GDP. In Europe, bank balance sheets are 4 times GDP. With as a consequence that if something happens in the banking sector, for the US, it's solved within 1 year, like the crisis of 2008. And in Europe, if something happens, it's even not solved after 15 years. Do we need banks with balance sheets that are 4 times GDP? I don't know. So, now let's go.
Sorry, could you maybe explain that concept further? But I can't, I don't understand it.
Well, if you have to rescue banks, because you cannot accept default. Because if you have a default, well, you will have a judge that says default, then you have a curator. The first thing he does is closing all windows and doors that no euro can leave. If you do that with a bank, like Fortis in 2008, 1/3 of the savings of the Belgian population, including also the demand deposits, were closed for, I guess, about 30 years. Liquidation of Sabena, but that was small against Fortis. Fortis was a balance sheet of 900 billion and consisted of over 3,000 companies, about everywhere in the world. So liquidating that for a curator would take 30 years. So 1/3 of the savings of the Belgian population would be blocked for 30 years. So you cannot afford a bank to go bankrupt. The only thing you can do as a government is to help it, which is not the normal way a market functions. And if your balance sheet, like in Belgium, of the banks is 4 to 5 times bigger than GDP, you need help that makes your country bankrupt. What happened with Greece and Spain, and potentially Italy, and Ireland, and Portugal, and Cyprus, but Belgium was also on that road. Fortunately, we had a solution, but that's not my criticism. But a bank then becomes a very dangerous thing.
That's an interesting slide that you showed, but I wonder if you also not have to look at the concentration, because in the United States you have the GDP and the political and the balance sheet on the same level, but is the concentration of the banks holding all the deposits not very higher in the States than in Europe? You have
No.
Because there are many banks basically in Europe, and we don't have big mergers of banks.
In the US, you have a couple of big, what they call national banks, who can be active in all the states, but most of the banks only have a license for one state. You have a totally different financial system.
Mm-hmm.
It's in Europe. It's terrible what the European Union is doing. I have to do a speech tomorrow, but it's a bigger monster than the financial system that the European Union has created. With that free banking all over Europe with one license. In the US, they're not so stupid. If you had a license of California, you can only act in California. And if you fail, you're the responsibility of the state of California.
A Bank of America.
Well, that's one of the big ones, and there you have the Fed and the OCC, and you have the whole bunch of supervisors looking. They are sitting in the trading rooms with the whole teams. And now you see, it's even that is not the monster. It's stronger than all these supervisors, wherever they do. But having smaller banks is reducing the responsibility of society against losses. The losses you can have in a market, but there is the individual investor, in theory. But in the banks, automatically it becomes government. And you could say that in the US, of all financial transactions, 80% go through markets, and all the rest goes through banks. In Europe, it's just the other way around. 80% goes to banks, and only 20% through markets. And then the European Union tries to launch the idea of a capital market union, and again, they're trying to do something against London, but it's not in the culture of Europe.
It's one continent, the US, and the same money that we have in Europe, but it's a different mentality as well.
It's a totally different culture. I'm not saying that we should copy the US, but it's not too bad to have a look at it. A far more segmented market, state by state. That's what also Lamfalussy says. In a big tanker, it's very expensive, but you put a lot of different compartments. It's not efficient. It's better to have everything together. But the compartment is that if you get to an iceberg, one compartment will go under, but the tanker will continue to go. So you make your boat inefficient, far too expensive, to prepare for accidents. That's, of course, not very competitive then. Okay, and then we come to the architectures today, how they try to organize the monster by saying, well, the centerpiece is money. Money is a public good, decided by government and parliaments, within a law that is the monetary law. And it can be linked to gold, as it was until 1970. Today it's linked to nothing. But you have a monetary law that says the Kingdom of Belgium, the currency is the euro. And the euro is legal tender, which means everybody in Belgium has to accept the euro as payment. So it's public good. That's why Bitcoin is not money, in the definition of money. But it does things that money also does. But it is not money. In El Salvador, Bitcoin is money now, since September. So everything is moving. Everybody is looking at that experiment. What are you doing with a country that says that the cryptocurrency is money? So the Salvadorians must accept Bitcoin as payment. And then the whole world starts. But that's the old model, is money is public, is government is country. Europe has created a monster with the euro. What all economists in '92 were saying, if you create a monetary union, you need to create a political union. And what Mitterrand and Kohl said, we'll see later. Now we have the consequence of a monster in the room. It's not an elephant, it's a monster. Because or you go now to a political union, and there's not a big appetite, or you get to increasing stress about the currency. And then you create a central bank, which is a technocratic institute that has to manage the money. The law is what money is, but someone has to manage it on a daily basis. Print the banknotes, make the coins, decide how much money we need in an economy. And that's technocrats who do it. And since 200 years, it's not the politicians themselves who do it. Why? Because confidence is so important. And politicians with their short-term vision cannot protect in the long term the stability of and the confidence in the money. And then we have financial markets, use money, but it's a world apart where the ECB has nothing to do. And you have the commercial banks, in principle not too involved with financial markets, but commercial banks create institutions, create money. That's another of the elements of the monster. You give a monopoly to the central bank that they only can print money. Take the European case. The total amount of money in Europe is about 9 trillion. The volume of printed banknotes is 800 million. So it's 1 trillion. The total amount of money is 8, but banknotes is only 1 million. Who has made the 7 other trillions? It's the commercial banks. Because they take your money as a deposit, so your money is in another form, which is on the accounting, on an account at the bank, but it's money. And then the bank is going to lend your money to someone else, who is going to spend it. So someone else has money, and you think you have money. And ultimately, that money that has been lended will return to the banks in the form of more deposits, which allows the bank to give more loans, which lead to more deposits. So if you have a systemic crisis of the banking sector, there is no other way than nationalizing them all and rescuing them. A little bit what the ECB does by creating 8 trillion from 500 billion to 8 trillion in about 10 years. The only question is the ECB still looking at the stability and the confidence in the currency? Or is it in a survival mode, because otherwise Greece and Italy and other countries could go bankrupt? So that's the old model, met the building blocks. And you see, everybody is talking to everybody. Commercial banks are doing transactions in markets. Central banks and commercial banks do transactions, and the central bank gives short-term money every week to the commercial banks in an auction. Commercial banks make money. Even 80% of the total money amount in the economy, but under the control of the central bank. They can, with the interest rate up and down, manage the capacity of the commercial banks to give loans or not. If the central bank thinks there's too many loans that could create inflation, they increase the interest rates. The mechanism is that all the commercial banks have to follow the central bank. And in that way, loans can become more expensive and people postpone loans, which calm down the economy, and that calms down inflation. and the ECB sees that inflation is under control, they decrease interest rates, which gives oxygen to the motor of loans of the commercial banks. So commercial banks in reality are puppets on a string. Who is playing with the puppets is the central bank. And the problem is now that the strings are broken. So the central bank is doing all kinds of things, but the puppets are not moving, or are moving in the wrong direction. So your system is broken. So these are the overlapping areas. Money is also in what is called fractional banking. And from time to time, you see the old theories of the 1930s coming back saying we have to stop fractional banking. Because the fact that commercial banks create money through lending is at the origin of a far too high monetary supply, and it's that we have to stop. And then the central bank, who also print money. So there are some overlaps. Now what we see is, since 20 years, the financial crisis has totally destabilized the roles of the central banks, has created a banking system where the average European bank, commercial bank, what is the price book value of the average European bank? 0.5, 2.6. A few banks are at book value, and even less banks do better than their book value. Normally, for an economy, for a market, if your price book value is below 1, it means that you're a dead sector. Because putting money as a shareholder in that sector means immediately you destroy money. You put €1, and in the share price it will go up with half a euro. And then you have that digital revolution, where also that old system that was conceived with the central bank and money is banknotes and coins, and the commercial banks under control of the central bank that can create money, and the market at a distance, was all in all these rules and regulations that are the framing of the financial system. Well, also the digital revolution is shocking the system. Like any technological revolution in the past has done, all these systems have to adapt to the capacity of all the time more powerful computers. And that is the result. Everybody is lost. For example, the central banks, certainly the ECB, but also Mr. Powell in the US, if Biden wants to invest $2 trillion in infrastructure in the US, who will finance that? Mr. Powell. He prints the money, he buys the bonds, and gives the money to Biden, who can then spend $2 trillion. They don't have to ask the market at which price, because it's a deal between the two. So central banks now, with the volume they have, are directly influencing prices on markets. If the ECB would not guarantee that every month I will buy for 30 billion or more government bonds, then probably the spread of Greece would not be less than 1%, as it is now. So saying central bank has nothing to do with markets, or is using the market as a normal investor in open market policy. No, the central bank is focusing on the price mechanism in the markets. If you have an investor with 8 billion, you cannot imagine that your market comes at the normal price. So the market is not functioning. Second, money, cryptocurrencies, and then the new generation of stable coins starts to invade the concept of money. With now El Salvador saying even Bitcoin is money, is legal tender. Now what is then the role of a central bank? And what do you do with the Tether and with the DM of Mr. Zuckerberg, who says, I am going to issue DMs, but I guarantee that one DM will always be equal to $1. You don't need the central bank then anymore. Or the central bank has nothing to say to Mr. Zuckerberg. That's why he hits the wall. And has now decided not to do it in Switzerland, but in New York, where then Mr. Powell is a little bit more reassured, and probably the discussion is going on to say, what are you going to do? That's another case. They do the same thing. They keep the Tether equal to the dollar, and they said, we are not a bank because we keep all the dollars on the asset side. So it's just two sides of the same thing, but we transform the dollar, but we keep the dollar. So it's fully covered. It's not fractional bank. What have they now discovered? That they have only 10% in real dollars, and the rest in all kinds of things. And then the Federal Reserve says, yeah, but then you are a bank. Then we have to apply Basel III. It's very unclear how this will all end up. Anyhow, these stable coins seem to be serious challengers for the normal, traditional, legal money. Then you have crowdfunding as a potential to give loans in the retail sector, potential. So take part of the commercial bank activity. The commercial bank, some start to think about developing business in cryptocurrencies, certainly in private banks, because they feel, of course, the pressure of their clients to say, you traditional private banker, you invest in all kinds of things, but the only people who make money nowadays is by buying bitcoins. They can no longer say, Bitcoin is not my business. Some investment funds are already linked to Bitcoin. So the Bitcoin will become also territory for commercial banks to do something. And then the central bank is also starting to invest in corporate bonds. Initially, central banks, there's only government bonds. Now they start to invest in corporate bonds. So they become competitors of commercial banks who also are helping issuing and giving loans. The ESG is going to speed up all this. Because suddenly the standards according to which a bank gives loans, looking at the probability of default, essentially, is now completed with a whole ethical frame of cleaning up the economy, and how are you going as a banker decide what is okay for ESG. You see already some saying no money anymore for the Shell and the Totals, the petroleum companies. You hear then BNP saying we are putting a lot of money to Total because they have promised us to transform themselves. Yeah, so you are financing, so that ESG is marvelous, but nobody has a clue about what it is. We still don't know at European level if nuclear power is ESG compliant or not. So what we do in Europe is we close all nuclear plants in Belgium, and Mr. Macron will open nuclear plants probably at the border with Belgium. That's Europe. So also that system is in a terrible shape. And then ultimately central banks have already announced and are concretely working with it to issue not cryptocurrencies but digital euro currencies. Where of course banks are afraid, are panicking, saying, well, if every citizen in Europe can have digital euros directly from the ECB, why opening a bank account? Because the role of a bank is obsolete. And then the ECB in a hurry I said, yeah, but we will find a way. And for example, we will limit the amount of digital currencies to 3,000 per person. How can you, what's the reason for 3,000? So it's something that everybody wants. And then ECB says, yeah, but you don't get it. It's a maximum of 3,000. So also there, we don't know. And then see, last September BIS document about the impact of CBDCs. It's very strange. One sentence, it says, CBDCs would have implications for financial intermediation. Of course. It's a disintermediation by definition. And would need careful design and implementation. Yeah, probably. But our analysis suggests that the impacts on bank disintermediation and lending could be manageable. The impact could be manageable. That's the BIS. Which means that they say, perhaps it's the end of the story. It could be manageable for the banking sector. Very, very difficult to think about how will our financial system function in 5 to 10 years. I'm not talking about the next century, it's about 5 to 10 years. All these things together. And the fintechs are playing then a role to invent all kinds of things and continue to destabilize because they are looking for the borderline, what they can do, what they cannot do. They are doing a very good job, but it's not stabilizing the system. So the role of fintech, think for fintech, all these moving creates opportunities for non-banks, and as who have now the choice, B2B, B2C, back office, front office, or the regulation even. Some red lines for non-banks, including for fintech today, is when they go to the retail as a front office, because then they hit the issue of consumer protection. If they become real bankers, like perhaps Stetter and DM, because then they get the whole banking regulation on their shoulders, which would be fatal for most of the ideas of the fintech. And then last, could be considered as a threat to financial stability. And that's one of the new parts of the financial supervision. Now you have a specific stability supervisor, which did not exist before the crisis of 2008, who is looking at the stability of the system. And if that supervisor in Belgium, it's the National Bank, it's Pierre Wunsch. In Europe, it's close to the ECB, it's the Systemic Risk Board. But if that supervisor thinks that some movements, even if they are non-banks, are dangerous for stability, for example, because of the size of these operators, they could intervene from the point of view of stability. If fintechs take into account consumer protection, not become a real bank, and take care for financial stability, don't become too important, well, then they can develop their creativity fully. But there are bordering, there are limits. Okay? That's it. So it's a boring subject. But you see that sometimes it's relevant to listen to boring subjects with a lot of history. Any question?
Yeah, a question on the mergers. We have a lot of banks. We see in Belgium that the fifth biggest bank is in the making. AXA and Crélan, taking over AXA, and there is a lot to do. From the ECB, is not convinced till now, and it takes a lot of time. what is your view on this, acquisition, I would say, because when you look at the balance sheets, AXA is kind of at par, I think. And what is the main critique of the ECB on this merger?
But I think it makes sense from a pure economic point of view. There are too many banks. Now already the previous, no, not the previous, the one before Jan Smets Koen said already in Belgium we have one bank, one big bank too much. And everybody was looking at Belfius that would be acquired by KBC. Nobody was saying it, but that was, in the meantime, Belfius is there and Belgium is overbanked. The big challenge is how can we, I think, reduce the size of these bank balance sheets, which means more development of markets. And that was the purpose of the capital market union that Juncker already 10 years ago was saying we are going to build a capital market union. Unfortunately, I don't see it. In the numbers, you don't see the movement. And then a merger of AXA, well, yeah, of course the ECB as a supervisor, it is a systemic bank, the merger of AXA, so they come on the list of the 120 European systemic banks. And then the supervisor is by definition worried. Is this under control? None of these two banks is really very strong from the point of view of equity capital. One is extremely weak, has been for sale for years, but what will be the impact? How will they emerge? Everybody knows how difficult it is to merge two banks, to merge IT systems, etc. And as it is a new systemic financial institution in the eyes of the ECB, it's directly under the control of the ECB, so they are asking all the critical questions as a microprudential supervisor. And then you have the contradiction in all the missions that the ECB has. It's the microprudential supervisor. But there's a conflict of interest between the microprudential supervisor and the monetary authority. There's a conflict of interest because as a microprudential supervisor, if you say, I agree with the models, I agree with, then you're responsible for the bank because you have given the license. So you are going to avoid difficulties with banks. That's called forbearance. You don't ring the bell because you're yourself responsible for giving a license. So you're going to hide the problem. All prudential supervisors are doing that. In Europe it was the case before the banking union that all national supervisors were hiding the problems. They all said in 2009 we are going to do a stress test, as Bernanke was doing in the US, but not at the European level. We are each going to do it ourselves for our banks. And all European banks were in strong and fine. And 2 weeks later, all Irish banks were bankrupt. That has been the argument to create the banking union at the ECB. But then you create another conflict of interest between the supervisory, micro supervisory, and the stability supervisor. That's why they have then split the stability supervisor in the ECB from the micro, but all the same people. There's a Chinese wall between the two of about 20 centimeters. So you create whatever you do, and that's that famous monster of Minsky. Whatever you do in the financial system, you create a monster of instability. I think the reaction of the ECB as microprudential against the merger of AXA and Crelan is justified because it's their job. The merger should be welcomed by the stability supervisor. Less banks is better.
Thank you.
So the less banks does not reduce their assets compared to the GDP.
Have
So
to-
why is it really better?
Yeah. you can hope that they will shrink their balance sheet a little bit. Indeed, that's the big elephant in the room, these huge balance sheets of banks. And nobody knows, you have now the law of resolution, but if you ask someone, if Deutsche Bank tomorrow falls down, will Europe use the resolution mechanism with the resolution board? And will it be possible? And then you see a lot of doubt.
Maybe the Greek will say no.
Okay,
Thank you.
thank you very much.
Thank you.